A fresh forensic screen finds two hard gate failures behind CapitaLand Ascendas REIT's growth story. Here is what Zone 4 actually means for your money. 1.41 billion Singapore dollars. That is the total outlay CapitaLand Ascendas REIT has committed to acquisitions year-to-date in FY2026. Over the last 5 years, cumulative distribution per unit growth stands at negative 1.7%. That gap, billions deployed, distributions going nowhere, is where this audit begins. CapitaLand Ascendas REIT is asking unit holders to trust that this time is different, that the 1.41 billion Singapore dollars currently being deployed into logistics and data center assets will finally translate acquisition growth into DPU growth after 5 straight years where it hasn't. Whether you are still building toward retirement or already drawing down CPF and SRS income, that is the exact question this piece exists to test, not RHB's growth story in isolation, but whether the balance sheet behind it can actually support the weight. 1.41 billion Singapore dollars committed to acquisitions year-to-date in FY2026, while cumulative distribution per unit growth over 5 years sits at negative 1.7%. That is the core tension right now. Billions of capital deployed into the portfolio, but distributions for unit holders are going nowhere. That sharp divergence between capital spending and distribution growth is precisely where our forensic audit begins. Well, 1.41 billion Singapore dollars deployed into logistics and data centers finally translate acquisition growth into DPU growth after 5 years where it hasn't. That is the central question facing unit holders today. This audit tests the balance sheet strength behind that narrative, rather than looking at RHB's thesis in isolation. We need to know if the balance sheet can actually support this weight. RHB Research reiterated its buy rating on CapitaLand Ascendas REIT on the 22nd of July 2026, maintaining a target price of 3 Singapore dollars against the prevailing 2 Singapore dollars and 49 cents trading price. That implies roughly 21% upside from current levels. Their core sell-side thesis centers on an aggressive portfolio revamp, recycling low-yielding assets into higher-yielding logistics real estate. On the divestment front, RHB highlights Kim Chuan Telecommunications Complex, sold for 200.4 million Singapore dollars at a 32% premium to valuation. That was an empty asset actively dragging on DPU, so selling well above book frees up capital cleanly. They also flagged optionality at Telepark, estimating 300 million Singapore dollars or more in value creation through redevelopment or divestment. Keep in mind, Telepark is still an option being evaluated, not a signed deal. Looking at asset injections, the property at Tuas Avenue 5 was acquired for 133.9 million Singapore dollars at an approximate 2% discount to valuation. On the metrics disclosed, this is a well-structured acquisition. It delivers an initial net property income yield of 6.6%, comes with full occupancy at 100%, and carries a 5-year weighted average lease expiry with triple net leases and 2% annual rental escalations built in. Long RHB notes positive rental reversions of around 11% in the first quarter of 2026, with full-year guidance pointing to high single-digit reversions driven by Singapore logistics, business space, and life sciences. On capital outlay, RHB models 1.8 billion Singapore dollars year-to-date. However, CapitaLand Ascendas REIT's confirmed disclosures for named transactions total 1.41 billion Singapore dollars. We treat that 1.41 billion figure as the verified baseline. Here is the load-bearing assumption supporting RHB's entire thesis. DPU uplift materializes visibly from FY2027 onward. That requires unit holders to absorb near-term balance sheet dilution and equity fundraising overhang right through FY2026 before any distribution payoff shows up. This is the exact timeline investors are being asked to underwrite today. When we run CapitaLand Ascendas REIT's primary disclosures through our 5-layer forensic audit, the balance sheet triggers 2 structural hard gate failures. Trailing yield passes at 6.03% against our 4.7% hurdle. But aggregate leverage hits 42%, failing our 35% ceiling. Interest coverage ratio stands at 3.5 to 3.6 times, failing our 4 times floor. Occupancy sits at 90.5%, triggering a major soft flag. Breaking down these hard gates, the trailing yield of 6.03% clears our 4.7% hurdle by 133 basis points, so income is above baseline. But leverage expanded 300 basis points quarter-on-quarter to 42%, failing the ceiling. Even after the equity raise, projections sit around 37.3%. Interest coverage ratio at 3.5 to 3.6 times breaches our 4 times floor, and under a 100 basis point rate stress scenario, coverage compresses further to 2.8 times. On asset quality, portfolio occupancy softened to 90.5% in the first quarter of 2026, down from 92.5% in the Singapore portfolio in FY2024. Nearly 1 in 10 units sits vacant, which registers as a major soft flag. Combined with an upward leverage trajectory and trading at a premium to fair value, CapitaLand Ascendas REIT accumulates two total weighted soft flags. Regardless of soft flag counts, two independent hard gate failures place CapitaLand Ascendas REIT firmly in Zone 4 caution. Income itself is healthy. The constraint here is gearing and interest coverage, not the dividend. In this framework, hard gates are not point deductions that can be balanced out by good news elsewhere. They are structural ceilings on balance sheet safety, and no other operational strength can offset them. The historical distribution record shows the core tension clearly. Across 5 years of aggressive acquisition outlay, DPU moved from 15.258 cents to 15.005 cents, a cumulative contraction of negative 1.7%. Filings confirm no special distributions mask this trajectory. This is the clean, unadjusted trend of capital expansion failing to generate distribution growth. Looking year by year, FY2021 delivered 15.258 cents, peaking in FY2022 at 15.798 cents. As debt costs escalated, DPU fell to 15.16 cents in FY2023, edged up slightly to 15.205 cents in FY2024, and dropped to 15.005 cents in FY2025. RHB's thesis asks investors to trust this 5-year declining trend will suddenly reverse without offering operational evidence that it has. This creates a wide forensic gap. RHB research holds a buy rating with a 3 Singapore dollar target driven by forward asset recycling and an FY2027 inflection. Our forensic audit places CapitaLand Ascendas REIT in Zone 4 caution with a fair value of 2 Singapore dollars and 11 cents driven by immediate balance sheet safety, leverage compression, and rate sensitivity where coverage drops to 2.8 times under stress. Seeing a 3 Singapore dollar institutional target alongside a 2 Singapore dollar and 11 cent fair value comes down to two different jobs being done with the exact same numbers. One framework focuses on marketing forward potential, while the other focuses on measuring balance sheet risk sitting in front of us right now. Equity research prioritizes total return potential through scale, asset recycling, and multi-year DPU inflection. Capital preservation prioritizes the balance sheet buffers that exist today, not the ones projected for FY2027. Institutional targets price future possibilities. A drawdown-focused framework prices current balance sheet reality. AHB's buy thesis requires trusting a forward DPU inflection that has not appeared across 5 years of aggressive portfolio expansion. The balance sheet carries 42% leverage and an interest coverage ratio of 3.5 times, both failing hard gates right now, not on a projected future date. The load-bearing assumption asks investors to underwrite dilution today for returns still a year or more away. 3 critical metrics will determine how this plays out. First, watch whether aggregate leverage actually settles near RHB's 37.3% target after the fundraising, or stays above 40%. Either way, it remains above our 35% ceiling. Second, monitor interest coverage compression. If coverage approaches 3 times under prevailing interest costs, refinancing risk escalates materially. Third, watch the FY2026 full-year DPU run rate to see if second-half payouts finally reverse the 5-year flat to declining trend. For an investor depending on portfolio distributions for living expenses, income reliability depends on debt stability, not just on the headline yield number. When leverage sits at 42% and interest coverage at 3.5 times, refinancing higher cost debt as it comes due absorbs cash flow that would otherwise fund distributions. This matters more acutely for someone already in drawdown than for someone still accumulating, because a retiree relying on this distribution to cover monthly expenses has no multi-year runway to simply wait out a rocky refinancing cycle the way a younger investor might. Growth funded by balance sheet compression quietly transfers risk from the REIT's own capital structure onto the unit holders' distribution. Watching debt metrics matters more here than watching acquisition headlines. The acquisitions are the story RHB is telling. The debt metrics are the story the balance sheet is telling. And right now, they are not telling the same one. Summarizing the forensic stance, CapitaLand Ascendas REIT sits in Zone 4 caution, and the constraint is gearing and interest coverage, not the dividend. The operational yield of 6.03% clears our 4.7% hurdle cleanly, so income remains durable at current levels. However, aggregate leverage at 42% and interest coverage at 3.5 times trigger 2 independent hard gate breaches. That is what caps the zone rating regardless of how attractive the headline yield appears. Whether CapitaLand Ascendas REIT belongs in your portfolio depends on your individual profile. An investor with a genuinely extended time horizon before capital drawdown may reasonably choose to absorb balance sheet dilution now, awaiting FY2027 asset recycling results. That is a legitimate choice for those who can afford to wait. Separately, capital allocated from a surplus beyond essential monthly cash flow can tolerate balance sheet stretch for growth in a way core income capital simply cannot. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.
Let's make it happen.